Well, on a lighter vein, you could be forgiven for thinking that you were not listening to the RBI governor, but the US Fed governor, because the commentary was very similar: sticky inflation and growth, and no signaling of any kind of a pause. What does this mean from an economy perspective, from the money markets perspective? Two people who can put this into perspective very clearly join us right now on the show, along with me, Neeraj Shah, and my colleague Pallavi Nahata. We have Jayesh Mehta, who's the MD and Country Treasurer of Bank of America, and Tanvee Gupta, Jain, Chief India Economist at UBS. Both of you, thank you so much for joining in. Really appreciate your time. Jayesh, can I start off with you? Initial thoughts, was the stance a bit of a surprise, or were you partly expecting it?
Not really, in the sense, stance would have been very difficult, and stance, as in traditional stance of stance, they have stopped giving in last 6-7 years, right? When we had neutral or it's only about the liquidity, which is more about accommodative or withdrawal of accommodation. So that continued, which was a little bit surprised, but that would have been normal thing, because with so much of liquidity, yeah, you have technical issues on liquidity because government it's still government balances are there, government not spending. When the government spend, they think the liquidity will come back in the system. So it would have been a little difficult on the stance side of it. But yeah, overall looks more cautious. People were expecting, like, it will be a little bit more dovish. 25 basis point was expected, but the commentary would be a little bit more dovish or more encouraging. But I think it's more cautious, and it's rightly so, because especially when you worked out from a high inflation, you want to make sure, and the word he uses, sustainable, lowering of inflation. And that's why it's only one component which has really come off, which is food, and we don't know the other component. Core is high, and of course, nobody knows. You want to wait and watch and see how, when China opens up, what is the impact of commodity cost and other things, right? So that's the reason maybe they are a little bit cautious. So I would put it this as a more cautious policy, not in their sense, in their mind, but from a market perception point of view.
Yeah, and kind of saw that in the way the initial reaction was, to be honest. Though I must say the equity markets have recovered very, very sharply. Tanvee, come in. Did the post decision commentary surprise you at all, or do you think? And also, do you think this is more intertwined with the global policy framework, or is it the RBI's confidence on growth as well playing a bit of a part here?
Okay, sure. So first of all, let me start with the latter part of your question, whether it is in line with what we were generally seeing in the rest of the world. I mean, recently we had the Fed policy where Fed also indicated that they are going to be data dependent. In fact, our UBS economics team is estimating one last 25 basis point rate hike by the Fed in the March meeting, which will bring their target Fed fund rate to 4.75 to 5%. Similarly, if I look at other Asian central banks, whether it's BOK, BOT, or Bank Indonesia, we have seen that they have increased the policy rate in the month of January. I mean, most of them had a policy last month, but they are also kind of signaling that we are approaching the tail end of the tightening cycle. I would say motivated by the same concerns what you are seeing in India, headline inflation peaking, the recent dollar weakness, and fears of a looming US recession. So I would say RBI has, by increasing the 25 basis point repo rate hike in today's policy, I think it's largely in line with expectation, and they have taken time in hand to assess the Fed action as well as the lagged impact of monetary tightening. I mean, they have effectively tightened by 250 basis point in this cycle so far on the growth inflation dynamics. So I would say from a macro point of view, and the RBI decision definitely data dependent, but very similar to what you are seeing has been the reaction by other Asian central banks. What is interesting in the policy, while the policy was largely in line with our expectation, 25 basis point rate hike, a 4 or 2 a split in vote 4-2. At the same time, we were not of the camp that there will be stance change right now, because liquidity is still not in that zone where you would expect stance to be changed. What is interesting is that RBI has kind of estimating a 6.4% GDP growth for FY24. I mean, just to highlight, we are at 5.5% GDP growth. And the inflation projections are slightly higher than ours. I mean, at 5.3 for FY24, at UBS, we are at 5.2. So the numbers definitely look a little challenging with such a strong growth and inflation only at 5.3 as per the RBI's forecast.
Pallavi?
So Tanvee, taking off from what you said, so so far the broad consensus was that this might be the last rate hike of this cycle before the RBI goes in for an extended pause. After today's slightly more hawkish than expected commentary, do you think that's still a little dicey? Does the RBI leave the door open for possibly another rate hike before it goes on for a pause?
I would definitely say the market has got divided, and a lot of market participants has viewed the policy as hawkish. But if you would have seen the RBI press briefing, they are clearly highlighting that the real policy rate, and the way they are looking at real policy rate, is the policy rate less 1 year forward inflation has already gone into positive territory, which is 90 basis point after today's hike. So I would say definitely they are not committing that they are done with tightening. They are clearly mentioning that we are data dependent. But our view is that this could be the last rate hike. And we are actually of the view that there will be an extended pause, at least till the first half of FY24. In fact, we have an out of consensus view that there could be more easing in late FY24, factoring in a slower growth where we are below consensus, and a sharp Fed pivot, which our global team is estimating. So that's largely we are on the other camp of the table right now.
All right. And like you mentioned, the GDP estimate, especially for Q1 next fiscal, is 7.8%. That does appear a tad bit optimistic.
Absolutely. So yes, there is a favorable base effect at play in the June quarter. My number is somewhere around 6.5 to 7. But RBI's today's quarterly profile of saying 7.8% in the June quarter definitely sounds quite optimistic. Similarly, if I look at their inflation projections, the inflation for the June quarter is still pretty high. They're saying at 5%, my inflation will be closer to, slightly sub 5%. So on that count, I would say they are expecting a stronger growth in the June quarter. And at the same time, the inflation projections are higher than what is laid out in my forecast. So in the April policy, I would expect RBI to go for status quo, because by that time, inflation ideally would have moved towards 5% and give them a much more broader sense of how inflation is going to pan out. Similarly, core inflation, while RBI governor kind of highlighted that core inflation is sticky, elevated, but if I look at going forward, my core inflation, which is averaging around 6% in FY23, is actually going towards 5% in FY24. So we are seeing moderation in core inflationary pressures going forward.
Okay.
Yeah, Jayesh, coming on, what does this mean for money markets? Bond yields showed that bit of a spike and then a kind of steady it there. But there has been, outside of the policy, there has been some perceptible weakness in the currency as well. What do you feel on both of these after the policy statement?
So firstly, currency, I would say, has nothing really to do with policy, just demand supply. So that's really, that doesn't change there. As far as money market and bonds are concerned, they were expecting 2-3 basis points, and that's what it has moved. After that, there have been some buying interest around by people. While it may, as I said, it looks like cautious. Instead of why it is putting as cautious or hawkish, right? They may be sounding neutral. They may be. But people thought that, with 25 basis point hike, they will give some clear indication that this is the last one and all that. But having not said that, naturally, how do you put that? Having not said that, I think people do believe that we are more or less done. 2 out of 6 didn't refuse, and unless something changes dramatically. And as Tanvee said, their inflation forecast also looks on the higher side from the market expectation. So that's why markets actually going with their own inflation forecast, which is definitely lower, because if you look at Q1, Q2, 23, 24, they haven't changed anything, whereas the world has become a little bit lower on the inflation side globally.
Yeah, no, I was only smiling because of the comment that I realized that the RBI put out when they talked about the chicken and the egg situation and said that let the chicken decide, and we'll come in later on. Jayesh, therefore, Jayesh, would you reckon that, what are the levels that you would reckon you would work around with, particularly the bond yield side? Because like we saw today as well, there was some buying from that 7.35 something, it cooled off a little bit as well from those hikes. You reckon these are about peak levels, or could there be higher
Yeah.
yields?
I think till at least March, April, we will see the same level. Of course, when the April supply starts, and then we have to see. He did say that the governor did say that they will manage the liquidity. We have huge LTRO maturing in April, particularly. If that liquidity comes back, and also on demand supply, that's what my worry is. Market's not looking at it. Market thinks that, okay, fine, last year the supply got absorbed by insurance and mutual funds and pension fund. This year also the supply will get absorbed, but there are always hiccups, and typically you see that hiccups in May, June, July, when the peak of the supply comes in. So from that perspective, can it go to 7.5, 760? Yes, it can. Will it stay there? The answer is no. So from that perspective, you might see some technical spike from demand supply basis, but otherwise, we would be around this level for quite some point of time, unless maybe in the April policy they just give a skip and may say they are comfortable with inflation. But it looks depends on what happens globally. I think one of the things, he didn't mention China, but I think there is a general consensus also, right? If China opens up, there will be pressure on raw materials, but there is also another thought that the final output would be lower if China opens up. So one has to wait and watch how it really pans out.
Yeah, just one question final, and then I'll let Pallavi ask her set of questions. But Tanvee, to you, if indeed there is also a train of thought, and we've spoken to a few people who speak about the possibility of another hike as well, even though you and Jayesh are not in that camp. My question is, if indeed there is one more hike, contrary to what you're expecting, does it change your growth estimates in any fashion whatsoever for FY24?
Not really. If you look at my growth estimates, we are at 5.5%. In fact, we had assumed some recession probability in Europe, which nowhere looks like. In fact, we have recently upgraded our European GDP forecast because of the warmer winters and the energy price situation not as drastic. In fact, there could be on the margin an upside risk to my 5.5% GDP purely on account of China reopening and Europe GDP being better than expected. So at this point, even if there is one more 25 basis point hike, which is not my baseline forecast, I wouldn't see there will be downside to my numbers.
Pallavi?
Mr. Mehta, I do want to ask you about what are the expectations from the central bank in terms of liquidity management here on?
So I think there was some very little, maybe 5%, 10% expectation on a CRR cut, which didn't happen. And there was also some expectation on narrowing of the corridor, right? Because earlier we had repo and reverse repo, which would have been the corridor at 25 basis point. Now we have MSS and SDF, which is 625, 675, so 50 basis points. So there was some expectation there. That has not come off. Maybe that will come off when we pause and go for accommodative stance kind of thing. So that won't come off. And I think people are worried about April particular LTRO maturity, because that was a long-term LTRO, right? So if they say that they will do repo or left windows and stuff like that, but that may not be a long term. It would be maybe short term. The one which is maturing was a real long term LTRO. So that's what people are a little bit worried about on the liquidity side. And I myself am worried about liquidity, because if your liquidity, and that's my personal view, if your liquidity remains tight, your bank deposit rates are bound to go up. And what we are seeing in the investment side, on the financial investment side, particularly growth on the insurance, mutual funds, and pension fund, provident funds, right? That's also linked to deposit rates. So if deposit rates are higher than government bonds, this instrument, the financial instrument, does not grow. If you look at the historical trend, that's what it has been, right? So, and I had this theory like 10 years back also. So whenever the deposit rates higher than government security, your financial savings will go into deposits and not into financial instrument like mutual funds or an insurance or a pension or provident fund. So that's what my worry is. If that happens, then the borrowing program target moves to banks supporting it. Last year was wonderful without OMO, without anything. The pension and insurance demand was so large that it really absorbed the huge borrowing program with ease, So that's what I would little bit worry. And of course, on the insurance side, we do have now that 5 lakh cap, right? So that also will, I don't know how it will pan out, but it will have some impact on that.
All right, Tanvee, my last question to you. I particularly want to focus on some of the downside risks that Governor Das as well highlighted, and Mr. Mehta also spoke about the China reopening, one instance, the global commodity price outlook once again looking up, as Mr. Das said. So, what is your take on these rising downside risks, and how much of a concern do they pose to the overall inflation outlook?
Okay. So the biggest concern or the biggest downside, I would say, to my overall GDP growth estimates for 2023 is a scenario where inflation remains sticky for longer. So even though my estimate is that inflation is going to go down from 6.5% to 5.2% next year, what if commodity prices rekindle because of China reopening, oil remains high or even goes up, and inflation remains sticky for longer? And instead of going down to say 5.2, it remains at 5.5%, 6%. In that scenario, I would say there could be a 40 to 50 basis point downside to my reported 5.5 GDP growth estimate, what I am estimating for FY24. So yes, the biggest downside scenario for India at this situation could be inflation remaining sticky for longer.
Hope that doesn't happen. But both of you, thank you so much for taking the time out and being with us and giving us a lowdown of your thoughts post-policy. Really appreciate your time.
Thanks.
Thank you.
And viewers, thanks for tuning in.
Thank you.